A mortgage pass-through security is issued by a mortgage originator, and it represents an undivided ownership interest in a pool of mortgages. Cash flows from that pool are distributed to security holders based on their percentage ownership on the pool. So, some key characteristics of these mortgage pools are going to depend on who the issuer is. Is it a mortgage company, a thrift, or Ginnie Mae, or is it Freddie or Fannie? And so remember, we talked about the differences between Freddie, Fannie, and Ginnie. Those key characteristics are is there a guarantor against default on the mortgages? So is there private mortgage insurance, as would be the case with Fannie and Freddie, or not with Ginnie or a mortgage company? What types of mortgages are in the pool? With Ginnie, there are fixed rate, graduated payment mortgages, manufactured housing mortgages, and adjustable rate mortgages. With Freddie, we would not include manufactured housing, but we would include multifamily, as well as seconds, which are mortgage pools that are secured by second mortgages. And then with Fannie, we would not include seconds, and we still would not include that manufactured housing that would be specific to Ginnie Mae or the private mortgage companies. But in all three cases, the interest rate on the mortgages in the underlying pools would be allowed to vary, and there would be an allowance for seasoned mortgages in those pools. The nature of the payment guarantee would vary slightly, but generally speaking, the guarantee would be for timely payment of principal and interest. And the guarantor, remember with Ginnie Mae, those loans would be backed by the full faith and credit of the U.S. government. But with Freddie and Fannie, the guarantor would just be Freddie or Fannie. So some factors that influence the pricing of a mortgage pass-through security include interest rate risk, which would mean that there would be reductions in the market value due to an unanticipated rise in interest rates. Default risk, which would be losses due to borrower default. The risk of delayed payment of principal and interest, or prepayment risk. So prepayment risk would be that risk that the borrower maybe refinances or just is able to repay the loan early without refinancing. And so the impact of that prepayment is going to vary depending on how many mortgages are in the pool, the distribution of interest rates, because if you've got already low interest rates in that mortgage pool, then those borrowers are going to be less likely to refinance because they'll be less likely to get a better deal as interest rates fluctuate. Another factor that would determine the impact of prepayment risk would be the number of seasoned mortgages in the pool, the geographic location of the borrowers, the characteristics of the household, and then just unanticipated events typically in the greater economy. So we can take a look at the mechanics of a mortgage pass-through. In this case is a 10-year mortgage pass-through with its starting pool balance of $1 million, and we see a principal and interest payment that is the same throughout the 10 years. but with no prepayment of principal. So that means that the total payments would just be the principal and interest, but then there would be guarantee and service fees. So obviously those would decline as the pool balance declines. And so the total payment to the investors would be that principal and interest payment less the guarantee and service fees. And so the payment to the individual investor would be that total payment divided by the number of investors. And with prepayment, borrowers have the option to prepay or repay the outstanding mortgage balance at any time. And so the expected maturity period for pass-throughs is going to be more difficult to estimate relative to other types of investments. Other fixed interest rate securities are generally more predictable with respect to when the repayment of principal can be expected. So it's going to be really important to determine what assumptions we're going to make about prepayments given the potential impact of those prepayments. And so a few different prepayment assumptions we can make are the average maturity. So we assume that a pool of mortgages is scheduled to amortize principal based on a given maturity, but the pool is totally paid off after some average period of time. So some will pay off sooner, some will pay off later, but we'll use an average. Another assumption is constant rates of prepayment. So that would assume that a constant percentage of the total mortgages in the pool would be paid off each year. The FHA prepayment experience. So this assumption is based on empirical evidence from actual prepayment experience that's collected by the FHA over time. And then finally, the PSA prepayment model, which is actually the standard, and it just simplifies the FHA prepayment experience model. So now, if we take our example and add in the prepayments, the impact is that the total payments would be the principal and interest plus those prepayments based on the assumptions that we're making about what prepayments are expected. And so now our total payments are higher, resulting in higher fees, of course, which are deducted from those total payments. And that changes our payment to individual investors.